Hi everyone, welcome to another video by Optionables. My name is Saket and this is the second part of the open interest video which we had done some time back. So in the first video, we had covered some basic aspects of open interest, how exactly an open interest gets created and what exactly it signifies. So today we are going to dig into certain deeper aspects of open interest as to how we can use open interest to base our trades. We'll be also seeing how we can actually use open interest to gauge the psychology in the market and much more. So what we saw previously was the basic video. So now we'll be covering few more aspects which are more useful for us in our trading every day. So we'll be quickly moving on to the video. Before we start off with the topic right away, we'll have a small briefing session where we'll try to understand what exactly we discussed in the last video. So it will be like a quick review if you have already watched the last video. If you haven't watched, you'll get a fair idea of what had already been discussed. So with this, we'll be quickly moving on to the video. Before that, if you're liking the content on this channel, then please do hit the like button, share this video as well as subscribe to Optionables. And you can also follow us on other social media platforms such as Twitter, Telegram, LinkedIn as well as Instagram, and the links are down in the description. Thank you so much for joining. Hi everyone, welcome to the second video of open interest analysis. So this is the intermediate part of the first video which we had already done. There we had covered the basics of open interest analysis and we had discussed three main aspects. We have further lot more aspects to discuss and we can go much deeper into understanding open interest and what exactly it means. Before moving on to the video, I would like to tell you a couple of things. The first thing is I would recommend you to play this video in 1.5x because the video will be little lengthy and you can finish the video faster. The second thing is we'll be mainly using Sensibull to analyze the data. And right now there is a 50% off going on Sensibull subscription for 6 months as well as 1 year. If you're interested, you can know more about it by clicking the link in the description below. With this, we'll be quickly moving on to the video, where we'll try to understand what all aspects is yet to be covered and what all we'll be covering today. Totally, there are 6 aspects that we have to still cover. One will be obviously doing a small recap of the previous video, just for us to brief on what exactly we had discussed, as it forms the foundation for us to build upon, right? After that comes the major parts. One will be understanding how to interpret OIs. What exactly is interpretation? Let's say I give you OI data, right? What is the best you can make out of it? What are the things you can analyze from it and what is the best you can make out of it will be discussed in this interpretation of open interest. Next comes, what is the relationship between market and open interest data? Even this is something very important and all of us should know. What is the relationship between market as well as open interest data? Then comes the practical aspect of how we can use open interest to make our trading decisions, how we can use open interest to make our adjustments, and I'll also be showing you one live trade examples. So these are the aspects which is yet to be covered, and I don't think everything can be done in one video because the video becomes very lengthy. Maybe we can split it into one more part. So in this video, we'll try to cover the first 3, recap of the first video, where we'll be understanding the basics. The second one, we'll try to understand how to do basic interpretation of OI. And we'll third understand the relationship between market and OI. So these 3 aspects will be covered in this particular video. Then I'll be coming out with one more video on OI this week itself, most probably in the weekend, where I'll be covering the remaining 3 aspects. So without wasting time, we'll be quickly jumping into the first aspect, where we'll see a quick recap of the initial video and we'll try to understand what exactly did we learn there. Coming to the first part, recap of the previous session, we had discussed 3 main things. First, who are the participants in the markets? We understood that there are 2 main participants, the retailers as well as institutions. And retailers, more than 95% of retailers usually end up losing money. So whatever decisions we make, we usually think in the perspective of institutions. So what is the big money doing? Is the institution buying or selling? Even general market, they see FII, DII data because institutions has the big money, and what they do actually significantly influences the market. Hence, it is important for us to always think in the perspective of the institutions, because if we think in the perspective of retailers, we know 95% of the retailers lose money. And if we end up thinking in the same perspective, even we will end up losing money. This is the first thing which we learned, that think in the perspective of institutions. Second thing what we learned is, so here is a spelling mistake. This is option sellers. Most of the option sellers in the markets are institutions. We also understood why exactly this is the case, because option selling requires a lot of margin, and hence a retailer cannot afford so much margin to sell options. Generally, institutions are the people who actually end up selling options. And third thing what we understood is, whenever we see high call open interest, let us say the call option side has way more open interest than the put option side. That means the market sentiment is bearish. And similarly, if there is high put OI compared to call OI, or put side open interest is more than the call side open interest, then the market is said to be bullish. I won't be covering in detail why exactly this is the case. If you haven't watched the first video, I urge you to watch the first video, because we have explained in detail why exactly high call open interest means bearishness and why exactly high put open interest means bullishness. Actually, Sensibull does a great job in representing this. You can see here, when you open Sensibull, usually call option is represented in red color. You can see wherever there is a huge call OI buildup, it is represented in red, and wherever there is a huge put open interest buildup, it is represented in green. This has a pretty good visual representation, which becomes easier for us to understand, right? Now moving on, this was a quick brief about what we had discussed in the previous video. Again, I would urge you to go and watch the first video if you haven't, because it will give a detailed perspective of the same. Next, we'll be moving on to the second aspect of this particular video, where we'll be discussing about how exactly to interpret OI. There is a very important thing that we have to understand when we have to interpret OI. What exactly is the OI telling you? What exactly is the OI data telling you? If I give you this particular OI data right over here of Bank Nifty, what exactly is this data telling you? This is very important for us to understand, and we have to also know how to use this data. If I just analyze the data and interpret it, it is not going to help me in any way. I should know how to use this data properly, right? First, before moving on and trying to understand what exactly this data is suggesting, I would like to tell you a very important thing. Whenever we are looking at OI, right, this is not going to tell you where the market is going to end. It is just going to tell you what are the participants in the market expecting. This is the only thing OI data is telling you. What is the expectation of the participants in the market? So what exactly happens? Let's say I have an expectation that the market will end up consolidating. The expectation of one more trader sitting in Mumbai can be different. The expectation of one more trader sitting in Kolkata can be different. There will be thousands and thousands of traders with different expectations, and they will base their trade based on their expectation. If someone is bullish, he will end up taking bullish position. If someone else is bearish, he will end up taking a bearish position. Similarly, if some institution is bearish, they will end up taking a particular position. OI is going to give you a summary of the expectation of participants. When you actually interpret the OI data, all it is telling is what exactly is the range expected by all the participants together in the market. What you have to also understand here is the expectations can change from day to day. Yesterday you might be bearish, but when the market started going up, you might change your expectation from bearish to bullish, right? So this is again very important to understand. The expectations can change. What OI data is suggesting on a Monday is not applicable to a Thursday. So right now people are expecting a particular thing. Tomorrow if the market moves up, people who are expecting consolidation can end up becoming bullish. People who are bearish can end up becoming bullish. So the idea of people or perspective of people can completely change overnight based on how the market moves. And that's the reason it is very important for us to understand that what OI data is suggesting today is the expectation of participants as of today. It can be completely different tomorrow. Hence, it is very important for us to track the OI data every day. What were people expecting today? Is the expectation intact for tomorrow? Is the expectation intact for day after tomorrow? If it is so, then we can actually end up holding on to our positions. Otherwise, we might have to make some small adjustments or anything of that sort. Based on this, we can base our trading decisions or adjustment decisions. Now we will understand the basics of interpreting the OI. The first thing what we learned is when there is a high OI on the call side, the market is bearish, and when there is high OI on the put side, the market is bullish. The second thing what we should know is whichever strike price on the call side has the highest OI. So highest call OI strike price is usually said to be the resistance, and whichever strike price has the highest put OI, the OI on the put side, that is likely to be the support for the market in the shorter run or at least till the expiry. So this is the second thing which is very important for us to know. First thing is regarding the market sentiment. Second thing regarding the support and resistance in the market. Now based on this particular data what we have right over here, we will try to identify the market sentiment as well as we'll try to identify the support and resistance. Right here I have opened the option chain of Nifty, right? So here we will first look at the total calls as well as total puts. So we can see that total calls is 56 million and total puts is 44 million. So which has higher number? It is obviously the call side, which has 56 and puts has 44. We'll just make a note of it. The call side has 56 million and put side has 44 million. Looking at this, since there is higher open interest on the call side compared to put side, you can say that the market is likely to face some resistance on the higher side. The thing here is I am not using the term bearish because the difference here is not significant. You can see the ratio is just around 0.8. So you can maybe say the market is bearish if it is something like 0.6 or 0.65 or something like that. 0.8 is not a significant difference between calls as well as puts. Hence, you can't really term it the market is very bearish. Hence, I am telling we might face some resistance at the higher end. So, compared to support at the lower end, there are higher chances or there is a stiff resistance at the higher end. So, with this, we understood that upside we might face some sort of resistance. And coming to the second part, which call has the highest OI and which put has the highest OI? If we have to look at this, so we can quite clearly see 18,000 puts has 4 million, which is the highest on the put side, and 18,200 has 5.3 million, whereas this also has 5.3 million. So right now we will just take 18,200 itself. So 18,200 has 5.3 million and 18,000 has around 4 million, right? So these two are likely to act as a very strong support as well as resistance. So what is our resistance? 18,200, because this has the highest call open interest. And what is our support? 18,000, because this has the highest put open interest, right? So with this, we arrived at the basic expectation from the market. So what exactly is our expectation? We understood first thing, market is likely to face some resistance at the higher end. Again, you can see that I am not using the term bearish because the OI difference is not very significant. If it is something like 0.65 or 0.6, then maybe you can term it definitely bearish. But right now the difference is not so significant. That is the reason I am using the term that the markets might face some resistance on the upside. Then we also understood that the market is likely to face some support at 18,000 and resistance at 18,200. So this is the interpretation what we got from the current OI data. So now we have to come with the expected range. Right now what we understood was just there is some sort of a resistance right over at 18,200, some sort of a support at 18,000, but this is not the expected range for the market. So then what exactly is the expected range for the market? For that, we will have to understand the premiums. So if you look at 18,000 put option premium, it is trading at 50 rupees, and 18,200 put option premium is trading at 65 rupees. So when I combine both of them, that is 50 plus 65, it's around 110. So the expected range for the market is somewhere around 18,000 minus 110 and 18,200 plus 110. So the expected range for the market is likely between 17,890 to 18,310. So this is where right now people are expecting the expiry to happen. So just because they are expecting the expiry to happen here, you can't say that the expiry will happen here. It is just an expectation that the market will likely expire in this particular range. So this is the first important part on how exactly you can interpret the OI data and form a expected range. So we'll be quickly doing that for Bank Nifty as well. Right now we did it for Nifty. We will try to form an expected range for Bank Nifty, and we will also try to understand what exactly we can expect from Bank Nifty. Right? So here we can see total number of calls and puts with a PCR ratio of 0.5. So what exactly this means? This means the market is slightly bearish. So it is not bullish because the call OI is way higher than put OI. Call OI is somewhere around 27 million, whereas put OI is around 14 million. Hence the market or Bank Nifty is likely bearish. Second thing what we understand is the highest OI on the call side is at 39,000 and highest OI on the put side is around 38,500. So we'll just make a note of this. So the highest OI is 38,500 on put side, which is likely the support, and the highest on the call side is 39,000, which is likely the resistance. So what is the expected range? So we'll quickly calculate the expected range by looking at the option premiums. So right now 38,500 has a premium of almost 175 rupees and 39,000 has a premium of 200 rupees. So both put together, what is the premium we have? 175 plus 200, it's around 375 rupees. So 38,500 minus 375, 39,000 plus 375. So when we add both of this and when we calculate, the expected range for Bank Nifty for this particular week is likely to be around 38,125 to 39,375. So this is just the expected range. Again, you have to be very clear here. I am not telling this is definitely going to be the expiry or this is definitely going to be the range for Bank Nifty. I am just telling this is the range which market participants are expecting as of today. Tomorrow they might completely expect something else, right? But as of today, this is the range they are expecting markets to expire, right? So this is a basic idea of how you can actually interpret the market data. So I hope that you guys understood this particular concept on how to interpret what is the support resistance and what is the expected range for the market. Next, we will be discussing upon one more topic on how OI and markets are correlated. So before we move on to the second aspect, I have a question for all of you. So in this Bank Nifty OI chart, we can all see here that 39,000 has the highest OI. So now my question to you is, can Bank Nifty actually cross 39,000 before this expiry? So I want you to pause the video and think carefully about this. Can Bank Nifty cross 39,000 before expiry? So this is the first question what I have. Second question what I have is, in case if Bank Nifty crosses 39,000, will the market go up? If the answer is yes, why will the market go up? So take some time, pause the video and try to think. Can Bank Nifty cross 39,000 before this expiry? In case if it crosses and it goes up, why will the Bank Nifty rally after it crosses 39,000? So the answer is Bank Nifty can definitely cross 39,000, because many people ask me, let's say 18,000 calls had the highest OI. So once it crossed 18,000 and they were like, 18,000 calls had the highest OI. How did Nifty cross 18,000? So my answer would be, just because it had highest OI, it doesn't mean that it can't cross 18,000, right? So again, I told you 18,000 is only likely to act as a resistance. It is not going to tell that is the upper cap. It can't definitely go above 18,000. Nowhere it is written that. It is only given that what is the resistance people are expecting. If resistance is broken, definitely it will go up much higher, right? So this is very important for us to understand. Just because there is highest OI here, it doesn't mean that Bank Nifty can't go above 39,000. That is a very false assumption what people have when they're looking at OI data. So always remember this, if there is high OI, it just means that there is resistance. It doesn't mean that Bank Nifty can't go above this particular level. Now for the second question, I'm pretty sure at least some of you might have thought that people will start closing their call option. Whoever has shorted 39,000 call option, they will start closing it. This short covering of call option will push the market higher. So what I would like to tell you is, this is the idea which is spread in most of the places. They tell that people, because they cover this particular call option, the market will end up moving higher. But that is absolutely wrong. So we'll try to understand why exactly that is the case. Options are the derivative contract. So they derive their value from the underlying. So underlying is not influenced by the options. So people were expecting 39,000 to act as a very strong resistance. So when people were expecting 39,000 to be a very strong resistance, they would have likely shorted more number of call options. Now, when 39,000 is broken, right? When 39,000 is broken, their psychological resistance is now taken out. Psychological resistance was market will likely not go above 39,000. But now the market has crossed 39,000. When the market crosses 39,000, what is your expectation? The markets will go up, right? So the markets will definitely go up because the market has crossed the important resistance zone and important psychological level. So when you expect the market to go up, you can't buy Bank Nifty, right? So you're expecting Bank Nifty to shoot up, but you can't buy Bank Nifty. What will you end up doing? So you will in turn end up buying shares of HDFC Bank. So you will in turn end up buying shares of Kotak Bank, because you are expecting Bank Nifty to go up. For Bank Nifty to go up, these stocks should actually end up going up. Otherwise, Bank Nifty won't go up. So hence, what people do, or what big institutions do, they end up creating long positions in HDFC, Kotak, ICICI, SBI, and so on. So what this does is it will push the market higher. When you actually start buying HDFC Bank or Kotak Bank, the prices will go up, and this will push the market higher. And when the market gets pushed higher, call option sellers will panic and they will close their position. So that's why I told, they closing their position of call option has nothing to do with whether the market will go up or not. If the market actually ends up going up, they will end up closing their call option. This is a very important point which I wanted to tell you. because many people tell you this: whenever people are closing their call option, the market is going to go up. So when there is a lot of call option writing which has happened and the market crosses that level, it has basically crossed the psychological resistance of most of the market participants. And what that will do, they will usually end up buying equity shares or creating long position in major equity contracts which has significant weightage, which will push the markets higher. So this is the reason why the market will go up in case if these levels are breached. So if this level is breached on the higher side or on the lower side, the market is likely to go up or fall because of the following reason. So for this video, I think we have covered two aspects. One is about identifying support and resistance and expected range. Using OI, how we can arrive at these two. And we also discussed the relationship between OI and market. Index is always greater than option. So what is happening to stocks, or whether people are buying stocks or selling stocks, has way higher influence compared to what people are doing with options, right? So this is very essential for us to know the third part, how we can actually start taking trades based on this OI data, right? So in the next video, we'll be covering aspects regarding how to base your trade on OI, then how to adjust your position based on OI data. I'll also be showing you a live example, and we will also cover aspects of how to identify change in psychology. If people change their expectation, let's say they were bearish yesterday, but today they became bullish, how exactly you can identify this change? Even that will be covered in the next video as well, because that is also very important. I missed out on telling it in the first part. So with that, we come to the end of this video. And I hope that you guys have liked this video. If yes, then please do hit the like button, share this video, as well as subscribe to Optionables. Thank you so much for joining.